Welcome everybody to podcast number 32 from True Potential, Doing More with Your Money. Today we've got an investment team special where we're joined by Paul Durrans, Barney Hawkins and Peter Andrews to discuss a number of things that have been happening in markets over the past week, past 10 days, but also to answer your questions that you've been very kind to submit over the past couple of days. So what we'll do is we'll kick off with our usual update on markets, and then we'll move into answering your questions over the course of the podcast. So firstly, I'll turn to Paul, and we'll get an update on what's been happening in asset markets over the past week.
Hi everybody. So if we just look at equity markets, so in the US over the week it's continued to push higher, so it's up around 2.6% as of close last night, with US tech stocks helping to push the S&P 500 and the Nasdaq to new fresh highs. Interestingly, you've seen the industrial sector do well, which is encouraging, just given how narrow the leadership has been in the recovery, with the tech stocks dominating the recovery. So industrials are benefiting from the better than expected economic data that we've seen in the US. So we've had good US retail sales, we've had good durable goods numbers. I suppose the big event over the past 24 hours are the comments coming from the Federal Reserve Chair Jerome Powell, who unveiled a new approach to setting US monetary policy. It was highly anticipated and discussed within the press, but they will now adopt an average inflation target. The bullseye remains at 2%, but the definition of that target has changed in a way that effectively raises inflation expectations and the inflation outlook, and this will be very important in terms of future policy making and current asset prices. So with the Fed no longer worried about higher inflation, arguably actively seeking higher inflation, we expect that interest rates to remain relatively low, or where they currently are for the foreseeable. It also adjusted its view of full employment to allow the labour market gains to reach more workers. And basically it's handing the central bank more flexibility to allow the job market to run hotter and price pressures to run higher before taking any action around interest rates. So that was a big event over the past 24 hours. I suppose what happened in markets on the back of that, well, I suppose the most noticeable move was in bond yields, and you saw yields rise on the back of higher inflation expectations, which you would expect, especially at the longer end of the curve, which meant that financials and real estate sectors benefited. So they were up strongly as they benefit from a higher yield curve. What has also helped push the stock markets higher over the week? Well, it's the developments we've seen in terms of the vaccine, and that's despite higher infection rates and new outbreaks. So the market's continuing to look past those. And if we look at other regions in terms of the UK, well, the UK over the weeks, the FTSE 100 is flat. The more domestic orientated index, the FTSE 250, is up 1%. In Europe, we've seen good gains, up 2.2%. So this is an area that we've been favouring within growth aligned for some time. Germany has been key to the recovery there, and they've announced further measures to extend their support program out to the end of 2021 to keep millions of people in jobs and allowing companies to retain their staff, which is important for their recovery. Also, you've seen France, they've hinted at further fiscal support in the rounds of about 100 billion euros to boost their economy. And then in Japan was trading higher until last night when you saw reports of Shinzo Abe, who's the longest reigning premier, is looking to resign due to health considerations. And so that's what's been happening in the equity market. I suppose in the bond market, it has been interesting to see the developments there, particularly in the sovereign bond market, where in recent weeks we saw US government bond yields reach all-time lows at around 50 basis points. But they've backed up quite considerably, especially yesterday on the back of those higher inflation expectations. But also you've seen a lot of issuance from the US Treasury. So supply outpacing demand, therefore yields effectively have to drift higher in order to entice investors back in. But it also goes to the better economic data that we've seen, which means there's less demand for perceived safe haven risk assets. So it has been interesting see the developments in sovereign bonds. I suppose in precious metals, which has been grabbing the headlines in recent weeks, so in gold and silver, both where we have exposure within growth aligned portfolios, they've been trading within a range. There's slightly up, silver slightly up over the week, but nothing like the kind of gains that we've seen over the past month or so. And then in currencies, we've seen the dollar weaken a little bit more. Today it's at 132.7. So the sterling's at 132.7 against the dollar, but nothing more to add than that. I think that's what I've seen over the week.
Quite a few interesting developments when we think about that, and some that are maybe very, very subtle on the side as well in terms of the change from the Federal Reserve. And I suppose it might be interesting to see when they set out how they think they're going to achieve something above 2% for inflation, because when we look back over the past number of years, they haven't, and they've set it as an explicit target. So we're talking about something that is quite a subtle but material change into how they think about policy. And I suppose we'll maybe get some more detail when they have the FOMC meeting in September, when they set out the groundwork for that. But quite a material change from the Fed there. Barney, have you got thoughts there?
Yeah. Well, the interesting thing I think on that is, as you say, it's a subtle change, but we've already seen an immediate, limited but immediate response from bond prices, and especially in this market, everything is feeding from bond yields, from bond prices, and so it'll be interesting to see what effect that does have, and what sort of further ramifications it has into a market that, on some respects is, it is looking fully priced. But then you look at, where things are priced relative to bond yields, and things look reasonable value. And if we have got this sort of subtle change in the sort of effectively the rules underpinning the bond markets, that will have sort of wider ramifications out, across other markets. I think that's going to be quite interesting.
And I suppose on that, it's the magnitude of the change over the coming months that will be the important driver of that. Because if we look at the 10-year, where we've got to in yields today is back to where we were just a couple of months ago, and I think it's important that we keep that in that context as well. So we'll have to see how that plays out over the coming, I suppose, months and weeks. What I find fascinating with it is that it's probably a a change from 40 years of Fed policy of really targeting inflation, and inflation being sort of the monkey on their back that they were trying to break all of the time. And that's been, since Paul Volcker time has been there, and now they're subtly shifting away from that, which could be quite interesting, but only time will tell. But I think, as you say, there's many aspects of financial markets that are requiring low interest rates, and I suppose governments as well, given the size of the fiscal deficits that we do have at this point as well. So a subtle change, but as you say, with maybe potentially quite significant ramifications over time. I think the other thing, Paul, that you touched on there is Shinzo Abe, and the potential that he is going to resign on ill health. And if we think about the policies that he's put in place over the past number of years, in his 8-year term, he's been very instrumental in changing Japan, and clearly any change there might be cause for concern from a market's perspective.
How would you assess Abe's overall performance, considering his entire thesis or his entire role and reason for getting into office? When he did years ago, and his outlook for what he wanted to achieve was to invigorate that economy again. How would you assess his performance in that view?
I think it's a great way to think about it, Peter, because he did come out with Abenomics was his sort of way of thinking about, from a fiscal and monetary perspective, to bring about change in the Japanese economy. I suppose if we look at inflation or things like that, did he achieve anything that he set out initially from that perspective? Probably not, other than when the consumption tax was changed and we saw those initial 2 changes, we saw a spike in inflation to compensate for that, and then it fell away again. I think some of the bigger changes are probably those that are around corporate governance and how the corporate sector in Japan has evolved. And if we think about corporate activity, the role of dividends in Japan was something that wasn't sort of as to the forefront. That has become more to the forefront over the past number of years. If we think about even environmental, social and governance factors as well, they seem to be becoming more prevalent as part of that. So I think we can say that from my perspective, it'd be good to get Barney and Paul's view on it as well, is that we've seen some change and some success, but if we were to go through a report card and mark it on what was set out 8 years ago, I think we'd probably say that some has been achieved, some hasn't. Still quite a bit of work to do.
Yeah, I think in terms of individual targets and boxes to tick, a lot of the boxes that were, a lot of the aims that were set out at the beginning, as Jeff said, haven't really, been hit. Has the economy been reinvigorated? Well, no, not really. But given the horrible demographics in Japan with an aging population, he was sort of, going the wrong way down the travelator into a headwind. He had, a very difficult job on his hands. So I think whereas, some of the individual targets haven't been hit, I think the culture has changed massively under his leadership. The shareholder, the end investor was always, the most important person within Western markets, and barely an afterthought in Japanese markets 10, 20 years ago. Now, Japanese companies are being run much more along the lines of Western companies. And for effectively one man to engineer that change in culture is a massive achievement. And I don't think we should underestimate that. And I think part of the problem that, Japan got into, going back quite a long way now, sort of 30, 40 years, was this, problem of cross shareholdings. And that's what, brought about partly what brought about sort of the massive crash in Japanese share prices that we saw at the end of the 80s. Blimey, I'm showing my age here. And there are still, cross shareholdings around, but it is not a predominant feature of investing in Japan now. And obviously Abe, has only been 8 years, but he's contributed to this whole sort of westernization, if you like, of Japanese business culture, which I think as investors we can only welcome. And I think part of the fall that we saw in Japan overnight, which was down I think 1.4%, is this, and not a fear that we're going to go back to those old days, but I think it's sort of more a recognition of this changing culture that has been brought about under his tenure.
I think Sorry, Paul.
Sorry, no, I just think it'll be interesting if you think about his policies. Have very much been market friendly. Adopting huge amounts of fiscal and monetary policy to drive growth and drive inflation, which arguably hasn't been there. It's who will then come in as the new premier, and what policies will they come with? Will they take a similar approach, or kind of stand back and say, well, under his regime, arguably it's been very expensive, but potentially not as successful as what was intended. So I think that will be something to watch out for. Who will be the candidates to succeed, and what policies will they adopt?
I suppose the other thing that we've been touching on this week is just the shape of global trade, and Japan is very much as an economy exposed to the trends in global trade, and we've seen that obviously being hurt very significantly with the implications of COVID-19 for economies and the closure of economies. Peter, I know you've been looking a little bit at that this week. Do you want to give the listeners some views on how trade has evolved and what you've been seeing?
Yeah, so if you look at kind of the headline broad figure for global trade volumes, that's taken into account exports and imports at a global level during the second quarter of 2020, whenever everything began to shut down in earnest and COVID began to wreak havoc across the West, especially. Overall, there has been a decline of around 12.5% during the quarter. But if you decompose that headline figure on a monthly basis, you begin to get a more positive picture. So overall, total global trade volumes increased by nearly 8% in June on a month-on-month basis. So that's a significant upturn, considering that we were falling by, I think, around, if I remember the figures correctly, 5.6% between March and April, and then further again between April and May. But I think more significantly than that recovery is that it seems to have broadened out in June, so from where it had been a few months earlier. So the monthly percentage change in trade volumes for nearly all advanced economies rose, with the exception of Japanese import figures, so maybe reflecting a bit of a lack of demand in that economy still. But if it just kind of break down some of those figures, over the month of June, US exports increased by 13% and imports were up by 3.7%. And the euro area, which is probably the largest trading bloc in the world, both from an internal perspective and external, their imports increased by 8.9% and exports were up by 11.9%. So if you take those indications from the second quarter at the kind of back end of June and project forward, then it sets up a bit more of an optimistic outlook for this quarter, which we should see in September. And absent any further lockdown, supply chains and the functioning of supply chains and demand for goods should keep increasing. And just speaking on something Barney mentioned earlier, industrial production, or sorry, Paul mentioned, I think, industrial production was really the driver of that. So you saw upturns there over the quarter as well. But I think, sorry, Jeff, go on.
No, I was just going to say, I think it's really encouraging when we see these data points and we can look at them, because sometimes we get, and the way data points are reported, it sort of fixates on the one number. But when you start to sort of peel back the layers of the onion and look in below it, and trying to look for trends and changes and inflection points, that's what we need to do at this point in time to be able to see them. Because if we just looked at the overall number, we'd have just said, well, global trade remains negative. But actually, the month-on-month trends are really important at the moment. And the work that Barney and Paul were doing earlier, looking at just the PMI trends and things like that, really gives us an indication of how that recovery is coming through in I would say globally. We're starting to see positive data points across most markets.
Yeah, I think for myself, some of the data points that I'll keep an eye on is just look at those regions that are well intertwined with the trade cycle. So thinking about Taiwan, thinking about South Korea, and looking at their export numbers, and they've been encouraging. If you look at US and Chinese new export numbers, they've been encouraging. So you can get quite quickly a good reading on global trade. I think clearly we're certainly not getting carried away with mobility restrictions in different areas and infection hotspots flaring up. But yeah, I think the data that is available from the likes of South Korea and Taiwan is becoming to be a little bit more encouraging. And I suppose that in terms of an allocation point of view, if we see more global trade, more globalization pick up there, then we probably look to allocate towards those more cyclical regions, where previously we've been looking towards those more defensive regions during the downturn. But if we see reverse of that, then we will allocate more cyclically.
I think that was something that we were starting to maybe pick up a little bit from some of the managers in the recent round of meetings that we had. I don't know, Barney, what were you picking up from those meetings and some of the key thoughts that you were hearing?
I think Paul's right. I think there is a generally a more positive outlook. We've got GDP improving for the first time in 6 months. The PMI data is coming through quite strongly. Just in the UK, this week we had retail sales which were up 1.4% on a year earlier. It doesn't actually feel that way when you walk down the high street, and there's been this massive shift to buying online, but it's still economic activity. Retail sales in the first 2 weeks of August up 7%. Now, okay, there's quite a lot of pent up demand, people who haven't been able to get out. I think there's this new phrase that's entered the vernacular of revenge buying. It's people who've been sort of hacked off with being sort of locked up and closed down for so long that they've decided to treat themselves, and that that's coming through, and that's great. And they're talking now about third quarter GDP figures being up 14%. So we're used to sort of GDP being half, three quarters, 1%. Now it's 14%, and that would if that comes through for the third quarter, that'll put us at the top of the G7 nations instead of at the bottom. And I think again that speaks to a lot of confusion around the whole business of gathering statistics. Statistics that we're used to being fractions are now not even whole numbers, but they're double-digit whole numbers. We're in a whole new ballpark, and those numbers are swinging massively from down 10%, down 15% to up 13%. And even the because of the restrictions of working from home and lockdown and all the rest of it, the compilation of those statistics is quite difficult. So the picture remains unclear. And even if those statistics, those hard numbers that we're getting are good and accurate, there's an awful lot that we still don't know how how deep the scarring may go, what the long-term effects of this lockdown and the resultant recession will be. And we had numbers from Rolls-Royce which were pretty dismal, sort of laying off 9,000 staff. So there are going to be casualties, but we know that for all of the bad news out there, there are some companies, our own included, which have done very well during this period, and the US market, I guess, is the most obvious sign of that, with the tech companies really powering through and lifting the S&P to its fifth record high in consecutive sessions over the last week. All the
here's a question for everybody. I haven't heard the term revenge buying before. So, what have you bought, Barney, or participated in that?
What have I bought? I'm thinking about replacing the car.
Right. Okay. Okay.
So that's something.
Hoping to complete on my first house today. So
excellent. Yeah.
That's an even bigger purchase than mine.
So Peter, you're going to have to top that. So we've got a car, we've got a house.
I was going to say my largesse isn't as extensive as those two, so I think I bought a very overly priced kettlebell for 100 quid. So pardon? Yeah, so it was whenever the gyms were locked down, I got sick of sitting in the house. Although a friend did buy a Peloton bike,
okay.
and a very inflated puppy, very costly. Apparently, there's a lack of source and an increase in demand.
And so inflation is everywhere, and puppy prices as well. So we've seen inflation tick up across. I wonder how that's captured in the statistics. Just maybe turning back then to the managers, Peter, you've been sort of looking at what we've heard from them. What's some of the key themes you've been taking from it as well?
I think, like Barney, I would highlight that there was maybe a slight change at the margin in terms of sentiment. So I think overall they were possibly a bit more optimistic when we had the calls around the outlook for kind of more cyclical regions and cyclical industries. But we're just taking stock at that point to really try and pick out some opportunities and find areas of value that would add value for clients as we move forward to Q3. I think some of the managers, especially the stock pickers, were really trying to set themselves up for the next earnings cycle. So really looking at those areas which can provide opportunity for growth over the next quarter. So overall, I think we just highlight that at the minute they are taking stock. And I think that's probably prudent given where we are at this point and the kind of volume of data that we're getting that can sort of undulate and change, week to week and even more on a month-to-month basis.
And it kind of speaks to the conversation that we've just been having for the past 10 or 15 minutes, that there's lots of data, there's lots of challenges to that data. We need to dig into it. Our managers need to dig into it, and trying to pick those subtle and shifting changes in trend is difficult. But that's what we're looking for them to do at this juncture, just given the amount of news flow that's out there. Maybe turning the conversation slightly differently and moving into some of the questions that have come in from our advisors. The first of which was talking about the US election, wanting to understand what our views are, what we've been hearing from our managers, how do we think about that. It's a vast topic. We could probably spend an hour, 2 hours, 3 hours talking about US politics. But Paul, do you want to kick us off with some brief thoughts there, and others please do chip in as we're going along?
Yeah, sure. I suppose a place where we can always start is just to have a look at the polls, where Biden's ahead, and he's been ahead, for some time. He's 7.1 in the polls, but that will continue to ebb and flow. It has done. If we look at, if it's 7.1 ahead now, he's been as high as 10, as low as 4. We've seen that he's announced Kamala Harris as his running mate, so she's well supported by the African American community. She takes a very tough stance on police reform, so that has helped Biden a little bit in the polls recently. What's key is going to be how the coronavirus evolves. Clearly, the Democrats really gained in February and March as COVID-19 broke out, as the pandemic has improved. Still not great, but it has improved since then. That momentum has been lost. If you look at the polls in terms of who's going to win the House of Representatives and the Senate, well, the Democrats are ahead there, and that's going to be really important in terms of Biden being able to push through his fiscal agenda. But clearly these things are never a done deal, as we found out at the last election. In terms of how it will affect markets, I think it will be, well, markets hate uncertainty, so probably lead to a bit more volatility. If we look at history, look at the US market, well, they typically trade within a range, but clearly there's a number of big factors impacting markets today that can change that. I suppose if Biden does get in, what he's expected to do? Well, he's expected to at some point reverse corporate taxes, so the opposite to what we saw with Trump. Last time utilities were a beneficiary of lower corporate taxes, so you might see the opposite next time. But higher taxes doesn't necessarily mean poor future returns. If we go back to 2013 with Barack Obama, who pushed through tax hikes, the S&P 500 went on to post its best annual gain in 16 years. They're expected to borrow more money to spend, and so you might see infrastructure do well. Biden's also expected to be less confrontational with China, more European friendly, and so that might just help the more cyclical regions such as Europe, the UK, Japan. I think what could be really interesting though is around share buybacks, and what we've seen over the recent years is US companies, and over here in Europe and the UK, but companies doing more, buying back their shares to juice up their earnings per share growth and inflate stock market valuations, rather than using their capital to spend on their own businesses and to grow their businesses. So that's come under quite a bit of criticism from the press, but also the Democratic Party and Biden himself. So if he does get in, it could be quite interesting to see whether companies bring forward their buybacks if they fear that Biden could introduce curbs on purchases. But that would be supportive for markets if we see more share buybacks than it has been. In terms of how we're preparing for it, in terms of growth aligned, well, we prefer not to take positions around political events, certainly something around the election, but if Biden got in, we could potentially tilt towards those more cyclical regions. So that's just my thoughts.
So it's interesting, as you say, there's a couple of months to go to the start of November. I'm sure there'll be many twists and turns over that period, and we'll get more details of what both parties, I suppose, are thinking about from a policy perspective and how that plays out. But I think the polls, as we know from past experience here in the UK and the last election in the US, can be sending you in one direction, and then the outcome is very different. So I think volatility, as you say, will be something that will probably come with this until we get to November the 8th and see the eventual outcome.
I think it's interesting that you mentioned sort of getting a better handle on policies. I think with the Democrats we will, and they're certainly associated with, the introduction of the reinforcing of the Affordable Care Act. There are, speculation that if Elizabeth Warren is made Treasury Secretary, she may implement this sort of some sort of financial risk fee on the banks, and those are sort of clear policies. And I think, as Paul mentioned, there will be a different attitude towards China. I think there'll be it'll be more of an integrationist approach and more inclusive with the international community. And I think certainly that aspect of policy would be welcomed from a Biden administration. In terms of getting more details from Republican policies, I'm not sure if I share your confidence, Jeff.
Yeah, we might get it on Twitter, although President Trump does seem to be using Twitter a lot less over the past number of weeks for some reason or other.
Well, I think what's come out of a sort of fairly mixed picture at the moment, and a lot of confusing signals, is the fact that there are always opportunities. And we've got the US trading at its high for the fifth time in as many days, but within the US market, look below the headline numbers of the provided by the tech companies and the FANGs. There are a lot of very interesting opportunities, and within the UK, we're still sort of 20% down this year, and there are a lot of opportunities there, and that the reason behind that, or the reasons behind the UK's underperformance are many and varied, but one of them is particularly to do with the dividend income and the cancellation of dividends, and what we're seeing from a number of companies that have just recently put out results is that they're reinstating dividends, or if they're not allowed to pay a dividend, or it's not appropriate for them to pay a dividend, they are financially able to pay a dividend. And I think that is certainly an area that investors will be looking at, and it's an opportunity. And as I say, there always are opportunities.
Maybe tied to that point as well, one of the other questions we have is around Brexit, and just that there seems to be little movement there in that regard. Is that also from your perspectives weighing down on the UK at this point in time, lack of clarity, or not, as the case may be?
I don't think. I think what we're seeing is a lot of posturing and a lot of positioning. Both sides are blaming each other for the intransigence. It was fascinating at the end of the last round of talks we saw under Theresa May's administration, the sort of fly on the wall documentaries with sort of European negotiators sort of laughing at the UK. So this round of negotiations, I think, is being conducted in a very different light. Also, I think the worst projections for the Project Fear Brigade about what can happen, what might happen if we leave the EU. Do you know what? Those are already here. We've already suffered a 15% drop in GDP. So the 3, 4, 5% drop that they were talking about potentially if we left the EU. We've had that with knobs on, and the sky hasn't fallen in. Also, I think we've had time to get used to the idea. The infrastructure is in place. The lorry parks have been built. We've got harbour masters at Dover and Calais saying, we're good to go. Whatever happens. And I think we have to be aware that everything that we see about these negotiations is carefully choreographed. Barnier, appealing to EU leaders to giving more flexibility in reaching a compromise with the UK. It's a negotiating position. The UK threatening that if the EU's intransigence forces us into a no-deal Brexit, then the 39 billion divorce bill, may be scrapped. It's a negotiating position. I think what we have to remember is that it's in both sides' interests to reach an agreement. The
And I
EU
suppose we've seen sterling start to, we've seen sterling tick up quite a bit over the past number of weeks, primarily, I suppose, against the dollar. Is there anything that we can read into what currency markets are telling us there?
Not a lot by the silence of the question. I think
suppose it maybe speaks a little bit to what you've been saying, that either the market is kind of viewing it as an event that we're, as you've alluded to there, Barney, that we're dealing with and we're moving forward and it will be resolved, or I suppose you take the opposite view and maybe the FX market's being slightly complacent, but time will tell as to where we get to in that one.
Yeah, I think the markets. What we have to remember is, most agreements, you've got people sort of, trying to come together.
Yeah.
In this one, we've already got an agreement, and we're just trying to sort of separate a bit. And I've no doubt that, at the 11th hour, an agreement will be reached, in principle, something that will allow us to move forward on January the 1st next year without, as I say, airplanes falling out of the sky, the ships sort of being stalled in the channel and the sky falling in. And the details will be hammered out. But the UK and the EU are and will remain inextricably linked by trade, and it's in both sides' interests to come to an agreement.
And that goes to the point Peter was making just about the size of the EU from a trading perspective, and why for everyone something has to be resolved in the right way.
I think just one interesting thing very quickly is that you can see how kind of emotional industries that perhaps don't contribute that much to overall economic growth, like fishing, for instance, can just looking forward as the UK begins to outline its relationships with other countries and other trade deals, how those kind of small sectors, which are potentially emotionally resonant with the population at large, and have vested interests in some communities, how they can potentially, how sticking points can arise for such a relatively low value relative to other sectors, parts of the economy. And so I think it's something to be mindful of as we begin to enter into negotiations with other trade agreements.
Okay. I think just I'm conscious of everybody's time, if we think about just one of the other questions that we've got from our advisors is, how do we think about ESG and how do our managers do that? How is that incorporated? I suppose maybe I'll throw my tuppence worth in at the start, and then we'll open it out. I think one of the things that as a business, as an investment team, what we've been doing, we've been engaging with all of our partners to think about their approaches and to understand their approaches to environmental, social, and governance. And I think one of the things that we're thinking about and considering, what's the right word for this? Is it ESG? Is it sustainability? Is it impact? And that in and of itself displays the challenges of thinking about these factors, and particularly how one thinks about them in a multi-asset construct. But we're in the process of engaging. We've had questionnaires and responses back from all of our manager partners about how they think about these aspects and how they incorporate that. And it's something that, as a business, we are working towards bringing out some of our own thoughts and articulating those over the coming months. I don't know, Barney, Paul, do you want to discuss maybe how some of the managers within the Growth Aligned and Fund think about ESG sustainability?
Yeah, I think it feeds into growth line. It also feeds into our auto enrollment default solution as well. We, myself and Barney, will actively engage with the managers to see what they're doing. And if you think about two of the managers that are held within growth aligned and the auto enrollment fund global managed, Legal and General and BlackRock in the where we have a lot of assets with, we've seen them make really meaningful changes. They have scale, they have resources, and they really are taking action to make a positive difference. So Legal and General are utilising their stewardship responsibilities to affect positive change in the companies and the assets on behalf of True Potential's clients and I suppose society as a whole. If we think about what they've been doing over the last year or so, they've been really focusing on climate change, supporting shareholder resolutions over improving gender diversity, income equality. They do ESG scoring, so they can score companies, give it based on the ESG criteria, and take action against those that score very low. If you think about what BlackRock have been doing, well, they've been trying to place sustainability at the heart of their investment approach, so integrating it into portfolio construction, risk management, and they look at companies to see if they have a sustainability risk and how they are integrating the climate risk into their business models. So they've been voting against those that are not integrating climate risk into their business models. So a number of our managers are making big progress and our leader taking.
I think the important thing there as well is just that they are. I think it's maybe a perceived thing that those that are using passive vehicles to get access to markets aren't able to move forward with these activities, but actually, given the way market structure has evolved, it's very much something that is at the heart of both the BlackRock and the LNG approach, and something that I think is sometimes forgotten in the marketplace, the role that these companies can have.
I think
sorry, go ahead, Barney.
I think, as you alluded to at the beginning, there's a lot of confusion over exactly what ESG is, and I think it means different things to different people, and I think it will become there's a certain amount of sort of greenwashing, if you like, and it will attract the attention of the regulators going forward. Just when you thought there was nothing left to regulate, I think ESG will give them something else to focus on. But I think what it does do, however you define it, it boils down to good practice. You don't want to invest in a company that's exploiting its workers. You don't want to invest in a company that's polluting the environment or has got sort of, shifty management. Because as an investor, these things, they may produce one set of good figures, but they come back and bite you. And the watchword, the mantra is always to invest in quality. And I think what ESG does do and is promoting is good quality management. And so I think in that respect, however much people sort of fly the ESG flag, I think it does involve just investing in good quality companies and good quality management, and that's to be encouraged for the industry.
And that's probably what we hear, Peter, when we think about the active stock pickers and how they engage with management teams, how they engage with boards on behalf of our clients effectively on a very regular basis.
Yeah, I think that's one of the benefits of having active stock pickers is that our clients benefit from managers who are sitting with management boards of companies and to drive change where they see fit. I also think that, one of the silver linings over the last few months and the COVID experience more generally, that did throw up difficulties for a variety of firms, but it's given our stock picking managers greater latitude to leverage their clout and motivate those management teams to accelerate plans to change, restructure the business practices where they see fit. And I think, as we continue to get inflows, that leverage is only going to increase, and we're going to see further and further engagement in the direction that, our stock picking managers believe is necessary to go down.
Okay. So the thing is, it's something that we're all moving forward with. Our managers are moving forward with, and we as a business are taking forward. But more will come on that. One of the other questions that we've got is around healthcare and just the performance of healthcare in the equity markets over the past number of months, and indeed the leadership that it, along with technology, has provided. What sort of exposure do we have within our portfolios to both healthcare and to some of the technology trends that we've been seeing? Paul, do you want to kick off on that?
Yeah, so we're not targeting it directly. I know some of our managers are doing, but we're getting our exposure through primarily through the S&P 500. So we're just taking a market weighting to that sector.
And if we think then about what some of our managers are doing, specifically you alluded to there what one manager is doing, they've taken a specific position in healthcare to reflect how they think about the longer term trends that are supportive of that sector. They have got thinking about demographics. Barney alluded to earlier, just the Japanese demographic situation. That demographic profile is probably comparable across large swathes of both developed and emerging and Asian economies over the coming 10 to 30 years as well. So they've got that as a longer term trend as part of their portfolio. I think if we aggregate sort of the exposure that we've got across all of our different managers, we do have quite a material exposure to the healthcare sector within True Potential, the True TPP portfolios at this point in time. So one that we'll look into, and we'll come back with the exact percentage that we have exposure there. In terms of technology, Peter, do you want to maybe touch on some of the exposure that we've got there, both directly and indirectly?
Yeah, sure. So I think for the portfolios, I think when we think of technology, probably the manager with the biggest allocation to that sector is Close Brothers. And if we look at their kind of allocation to technology stocks at the end of July in the balance fund, just taken as an example, it was around 20% of the fund's sectoral exposure. And you've got some huge names in there like Microsoft, Adobe, and Alphabet, beyond Google. But just speaking, maybe turning back to the healthcare sector and maybe looking at how that sector is changing over time and the impact it's having in other sectors. They recently put a position in a firm called Cerner, and they're a company that specialises in electronic health records. That's their traditional business. But since the last few years, they've began to take advantage of a trend of increased liberalization in healthcare data in the US and Europe. So really what they're doing is they're providing data to patients to provide personal medical use and treatment. So that's a position that really traverses the boundary between healthcare and technology. And you're probably going to see more instances of that. And if we just to bring it back to Cerner very briefly and to kind of give an example of how that's used, they've recently announced a tie-up with Amazon to supply Amazon fitness band, a new fitness band that Amazon are bringing out called the Amazon Halo, that allows users of that band to connect to Cerner's databases and can share data, according to specific personal health metrics. So from the comfort of their home. So I think that's the vision that we're going to see from more companies trying to utilize as much tech in their propositions as possible.
It's interesting when you say they're sort of crossing the boundaries and a healthcare company tying up with Amazon. If you think about just You mentioned Microsoft there, and what we've heard overnight about potentially Walmart joining with Microsoft to bid for TikTok, which for those that listened to the podcast a few weeks ago, you'd have heard me trying to figure out what TikTok is, because I'm too old to use it. So I find it fascinating that Walmart, traditional bricks and mortar retailer, owner of Asda here in the UK, would be wanting to join that bid with Microsoft. But it just shows you, as you've alluded to there, Peter, the blurring of these lines between business models, and where Walmart potentially see value in TikTok as well.
Well, we had Lloyd Blankfein, the outgoing head of Goldman Sachs a couple of years ago, said that Goldman Sachs employed more IT people than investment bankers, and so obviously Goldman Sachs not an IT company, but it is this sort of blurring of lines, and tech, a number of years ago was a distinct sector. Now the tech is sort of integrated into every company. And it's those companies that use tech that will be the winners going forward.
I think that's what we've seen as a business, and over this period of having to deal with working remotely has really brought out the benefit of having a digitalized business, and even more digitalizing the business as we've been going through lockdown, such that nearly 100% of all of our business can be conducted online. You think about us as an investment team, the sort of the paper and things like that we did use a number of months ago, 5-6 months ago. We don't use any of that any longer. It's everything is effectively electronic. So there will be winners and losers, but I think, as you rightly point out there, Barney, those that are investing and have made the investment are kind of reaping a bit of that benefit at this point in time. And that, I suppose, that brings me on to another question that we've got, and it's around our plan to return to the office, or does TP plan to return to the office? And I suppose the answer to that is that we do. We are going to return to the office in the coming months, or in the coming month, I should say, next month. But what we're going to do it in a hybrid manner. We're going to use the office. We're also going to use the working from home and the benefits that provides as well. So it's going to be a flexible model as we work our way back into working from the office in Newcastle. So you'll maybe get a very different podcast experience in coming months. It won't be the backgrounds of all of our homes. And then just maybe finally bringing it all to a conclusion, I think we've had a really interesting discussion, sharing many of the themes that we as a team have been discussing, but also those areas that are of interest to our advisors at this point in time. And again, I just say thank you for sending the questions in. Please do continue to send them. We enjoy taking part in these types of discussions. So with bank holiday weekend, lockdown measures have all eased. What have people got planned for the weekend? Maybe turn to Peter. We'll come to you first.
So depending on the weather, I was going to go for a couple of hikes with my girlfriend, but we'll see how that plans out. I'm not overly optimistic that that's going to stay.
Hopefully the rain that it seems to have been raining here for a week, if it could stop, it'd be good if it could stop for the long weekend. What about you, Paul?
It'll be a couple of days tonight, and then potentially a trip to IKEA tomorrow, which is going to be depressing. And then potentially, depending if I get the keys or not, hire a van and a trip down to Yorkshire to get a few bits and pieces from my dad and move things in, cleaning out the current flat that I'm in. It's not that enjoyable, actually.
And what time should you expect the keys at?
Well, I've got some money to transfer over first, but depends on the estate agent and everything getting signed up with the solicitors. So it could be today, it could be Tuesday.
Well, fingers crossed for today. And Barney, what about yourself?
Well, given the weather, it'll be interesting. But my daughter's got a surfing lesson at Tynemouth on Sunday, so we're going. Well, unless the sort of hurricane picks up, we're going to do that. So watch her get sort of wet and cold and fall in. So
you're not minded to take a surf lesson yourself? Or...
No, I have tried it, and I think I'll leave that to her. But I think as far as I'm concerned, it might be getting out on the bike and then a lot of dog walks and watching my daughter get wet and cold.
How about you, Jeff? Embracing this weekend?
What are we going to do? We're going to get the boys go back to school next week, so there'll be a lot of getting things organised for that. So not a typical bank holiday weekend here for us this weekend. Super. Well, thanks very much, everybody, for joining. Hope you found it useful. Please also look at our True Potential YouTube channel. You'll see some of the work that goes on in the background. The work from home video this week is by Graham, who produces all of the video content for the business. So please do have a look at that and see what goes on in the background. Thank you very much.
Subscribing to True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.